In March 2023, Silicon Valley Bank collapsed in 48 hours. Every headline focused on the speed, the panic, and the shockwaves sent through the tech world. But the most important part of that story was never printed on the front page. Dozens of smaller U.S. banks faced the same pressure at the same moment, and their survival had nothing to do with strength, stability, or superior management. They survived only because the panic stopped before it reached them. That event wasn't just a failure, it was a preview. It exposed a truth the public still hasn't fully absorbed. Many small banks in America are far more fragile than they appear, and the conditions that nearly broke them are resurfacing again. Only this time, the underlying weaknesses run deeper. If people understood how vulnerable the smaller institutions truly are, they would look at the banking system very differently. Before continuing, take a moment to subscribe, like, and comment to support this style of deep dive financial analysis. Now let's break down what's happening behind the scenes. The collapse of Silicon Valley Bank was framed as a unique case, driven by an unusual customer base. But the mechanics behind the failure were not unique at all. The bank collapsed because it had too many long-term assets and not enough liquidity during a moment of stress. That same mismatch exists across hundreds of small and mid-sized banks today. Rising interest rates exposed a simple mathematical truth. When yields rise fast, the value of older bonds collapses. Banks are forced to hold those losses quietly on their balance sheets, recorded as unrealized, until customers begin withdrawing money. Then the losses become real, and the institution unravels. This is not a theoretical risk. It is already visible in FDIC data, which shows that the total unrealized losses on bank securities remain among the highest in modern history. Small banks, which hold a disproportionately large share of long-term securities, are feeling the pressure most intensely. The public often assumes that if a bank is still open, it must be healthy. But banking is not like other businesses. A bank can appear strong one day and collapse 2 days later. All it takes is a shift in customer behavior. Unlike large banks, which have diversified deposits, multiple revenue streams, and extensive liquidity backstops, smaller banks rely heavily on local deposits and community customers. When even a small percentage of those customers withdraw money at the same time, the bank's stability begins to collapse rapidly. This vulnerability is amplified in a digital age where withdrawals no longer require lines or paperwork. Money can vanish from a small bank in minutes, not days, leaving the institution to scramble for liquidity it does not have. The stress facing smaller banks today is being driven by something deeper than interest rates: the slow disappearance of deposits. Over the last several years, more than $1 trillion has shifted out of small banks and into large institutions, money market funds, and high-yield alternatives. Customers are behaving rationally. The largest banks offer safety. Money market funds offer higher returns. Small banks, meanwhile, offer neither. This ongoing migration of deposits is starving smaller institutions of the resource they depend on most: cheap, stable funding. Without deposits, small banks cannot lend, invest, or maintain liquidity buffers. They are being slowly hollowed out from within, and most people do not see it happening. Another overlooked factor weakening small banks is the shift in the commercial real estate market. For decades, community banks played a major role in financing office buildings, retail centers, warehouses, and local developments. Commercial real estate loans provided stable, long-term income that supported thousands of regional institutions. But the landscape has changed dramatically. Remote work crushed office demand. Retail shifted online. Property valuations dropped. Vacancy rates rose. Refinancing became more expensive. Many commercial borrowers today are struggling, and some are defaulting. Because small banks hold a disproportionately large share of these loans, they are exposed to risks that have not yet fully materialized in the headlines. A wave of commercial real estate deterioration could push many smaller banks past their limits. Regulatory changes also contribute to their fragility. After the financial crisis, large banks faced strict liquidity and capital requirements. Smaller banks were exempt from many of these rules because policymakers believed community institutions posed less systemic risk. Ironically, this exemption now leaves the smaller banks more exposed. They entered the current high-rate environment without the liquidity structures that big banks were forced to develop. As a result, their bond portfolios are more vulnerable, their capital buffers are thinner, and their funding mix is more precarious. When market stress hits, they do not have the layers of protection that large banks rely on to maintain stability. The deeper structural issue is that the small bank business model has not adapted to the modern financial environment. They depend heavily on net interest margin, the spread between what they pay depositors and what they earn on loans. But when rates rise, depositors demand higher returns, and banks are forced to increase what they pay. At the same time, older loans on the books continue generating low income, and new lending slows due to economic uncertainty. This squeezes profitability from both sides. Many small banks are now operating with shrinking margins, rising funding costs, and limited ability to grow. Their earnings, which once provided stability, are eroding quarter by quarter. Technology is another quiet disruptor. Younger customers prefer digital-first banking. Fintechs and online banks offer convenience, better interfaces, and higher interest rates. These alternatives siphon both deposits and attention away from community banks. Local branches, once the lifeblood of small banks, are no longer essential to most customers. This shift is weakening the relationship-based model that community banks relied on for more than a century. Without strong relationships, small banks lose their competitive advantage. They become just another financial institution competing on rates, and in that competition, they lose every time to bigger players. The U.S. banking system is structured in a way that magnifies these weaknesses. America has far more banks than other developed countries, many of them tiny, serving narrow local markets. In an era of national-scale technology, rapid money movement, and rising financial sophistication, many of these institutions are simply too small to compete. They lack the resources, the digital infrastructure, and the diversified portfolios needed to withstand prolonged economic stress. Market forces are pushing toward consolidation, but consolidation is slow, politically sensitive, and often resisted by local communities. The impact of small bank weakness extends far beyond the institutions themselves. When small banks struggle, local economies feel it first. They provide nearly half of all small business loans in the country, a level of support that large banks do not match. If they fail or reduce lending, small businesses face fewer financing options, making it harder for them to expand, hire, or even survive. This would not create a headline collapse, but a slow economic suffocation across hundreds of towns and cities. Economists call this a credit contraction, and it is one of the earliest signs of recession pressure. The Federal Reserve and regulators are not ignoring the issue, but their tools have limits. Emergency lending facilities can provide temporary liquidity, but they cannot solve long-term structural problems. Deposit insurance can prevent panic, but it cannot restore shrinking margins. Supervision can identify risks, but it cannot force profitability. The reality is that the banking system is experiencing a transformation, and smaller institutions are being pushed toward the edges. Some will merge, some will shrink, some will fail quietly through weekend closures and FDIC announcements. The public may barely notice when it happens, but the economic impact will accumulate. The reason the current situation feels hidden is because there is no dramatic event attached to it yet. No mass failures, no televised panic, no lines outside branches. Instead, the deterioration is occurring gradually through balance sheets, funding flows, and customer behavior. This makes it far harder for people to recognize the pattern. But the pattern exists, and its direction is unmistakable. Deposits moving away, margins shrinking, asset values declining, risks rising, and resilience weakening. If nothing changes, the U.S. banking landscape will look very different within a few years. A smaller number of large institutions will dominate. Mid-sized and small banks will either consolidate or close. Local communities will lose their financial anchors. The economy will rely even more heavily on centralized institutions. And the next moment of financial stress, whether triggered by rates, recession, or real estate, will test the system in ways we have not yet seen. This is the stage being set right now, quietly, behind the scenes. And most people won't realize how fragile the system became until a small bank fails. And this time, the panic doesn't stop. The fragility of small banks becomes clearer when examining the structure of their balance sheets, because the numbers reveal a story that most depositors never see. A major portion of their assets is locked in long-duration securities purchased during the era of near-zero interest rates. Those bonds looked safe at the time, generating modest but predictable income. But when the Federal Reserve raised rates at the fastest pace in 4 decades, the market value of those bonds collapsed. Small banks do not have the capital buffers or diversified portfolios that large institutions rely on to absorb losses, so they now sit on enormous unrealized losses that weaken their financial foundation. These losses are tolerated only because the banks are not forced to sell the securities. But if depositors withdraw money, the bank has no choice but to sell assets at a loss to raise cash. That forced selling is what transforms a theoretical weakness into a real crisis. This problem is amplified by the way small banks manage liquidity. Many of them invested heavily in mortgage-backed securities or municipal bonds, believing the low yields were acceptable because deposits seemed stable. But the rise of digital banking changed the speed and behavior of money in ways these institutions were not prepared for. When customers can withdraw hundreds of millions of dollars with a few clicks, liquidity is no longer a slow-moving issue. It is an instant threat. A bank that once expected withdrawals to occur gradually over weeks or months now faces the possibility of large outflows within hours. This mismatch between asset liquidity and withdrawal speed is one of the most dangerous structural vulnerabilities in modern banking, and small banks are positioned at the center of it. The disappearance of deposits is accelerating the problem. Households and businesses increasingly move their money to the institutions that offer the highest perceived safety or the highest return. Large banks benefit from implicit government support. Money market funds benefit from higher yields and daily liquidity. Treasury bills offer safety backed by the U.S. government. In comparison, small banks offer low yields and limited digital infrastructure. As a result, they are losing deposits at a speed that resembles a slow-motion bank run, not triggered by panic, but by rational economic behavior. The outflow is steady, persistent, and difficult to reverse. Without deposits, banks cannot lend. Without lending, they cannot earn. Without earnings, they cannot strengthen their capital. This feedback loop is steadily weakening the community banking sector. Another layer of risk sits inside the commercial real estate portfolios of these smaller institutions. For decades, small and mid-sized banks financed local office buildings, strip malls, warehouses, hotels, and multifamily units. These loans were considered safe because the properties generated steady income and property values rose consistently. But the post-pandemic environment transformed the economics of commercial real estate. Remote work hollowed out office demand. Retail vacancies climbed as consumer behavior shifted online. Rising interest rates made refinancing more expensive. Thousands of properties nationwide are now worth significantly less than the loans attached to them. When borrowers default or fail to refinance, the losses fall directly onto the banks holding the loans. Because small banks hold nearly 70% of all commercial real estate loans in the U.S., they are exposed to a level of risk that could remain hidden until borrowers begin missing payments in larger numbers. The danger is not just individual loan defaults, but the systemic ripple effect that follows. When commercial real estate values fall, the collateral backing the loans weakens. When collateral weakens, regulators pressure banks to increase reserves or write down assets. These write-downs erode capital ratios. Lower capital ratios restrict lending. Restricted lending slows local economies. Slower economies lead to more loan stress, and the cycle repeats. Small banks do not have the profit margins or diversified operations to absorb widespread real estate deterioration, so even a modest downturn could push many toward insolvency. Rising interest rates also revealed another weakness: the growing reliance on uninsured deposits. Many small banks serve business clients, local firms, nonprofits, and institutions with large cash balances. The competitive landscape is also shifting in ways that disadvantage smaller institutions. Large banks have embraced advanced risk modeling, powerful data analytics, and automation to improve efficiency and reduce exposure. Fintech companies offer instant loans, high-yield savings accounts, and seamless digital onboarding. Online banks attract younger consumers who prefer speed, transparency, and convenience. Community banks, meanwhile, operate with legacy systems, limited technology budgets, and slower processes. Their competitive edge was always personal relationships, but modern customers, especially younger generations, simply do not prioritize those relationships. They prioritize returns, speed, and digital access. As customer expectations evolve, small banks struggle to meet them, turning their traditional strengths into modern weaknesses. Another factor often ignored by the public is how regulatory cycles impact small banks. During periods of financial stress, regulators increase oversight, tighten capital requirements, and demand higher quality assets. While these measures improve safety, they also increase operational costs. Large banks can absorb these costs through scale. Small banks cannot. The compliance burden becomes disproportionately heavy, reducing profitability and pushing more institutions toward mergers or closures. The same regulatory framework designed to protect the banking system ends up accelerating the decline of its smallest members. The future is also shaped by demographic shifts. Rural and aging communities rely heavily on their local banks, but these regions are experiencing slower economic growth. Younger populations are moving to cities or adopting national digital banks. Small businesses are increasingly using online payment systems and digital financial services. These changes reduce local banking activity, weakening the revenue base of community banks. At the same time, the cost of maintaining physical branches continues to rise. Many small banks are caught in a difficult bind. They cannot afford to maintain their local presence, but they cannot afford to abandon it either. This strategic dilemma leaves them exposed on both fronts. The deteriorating financial health of small banks can eventually influence the broader economy through what economists call a credit crunch. Small banks supply nearly half of all small business loans in the U.S., fueling entrepreneurship, local jobs, restaurants, construction firms, independent retailers, and regional industries. If these banks tighten lending or fail entirely, small businesses lose access to capital. A reduction in lending is rarely dramatic. It happens slowly, through stricter criteria, reduced limits, delayed approvals, or higher collateral requirements. But the cumulative effect can significantly slow down economic activity across thousands of communities. This is how a banking crisis transitions from the financial sector into the real economy. Even the psychological aspect should not be underestimated. Banking depends on trust. When trust erodes, customers behave defensively. They move deposits, delay borrowing, and reduce risk-taking. Small banks cannot afford even small shifts in customer sentiment. A few dozen nervous clients withdrawing money can destabilize an institution. In contrast, large banks have the scale and diversification to survive waves of uncertainty. This asymmetry is widening as financial conditions tighten. There is also a hidden dimension in the way banks interact with one another. The interbank lending market allows institutions to borrow from each other to manage liquidity. But when stress rises, large banks become more cautious about lending to smaller ones. This reduces available liquidity for small banks, pushing them closer to the edge. The very system meant to distribute stability becomes a mechanism that accelerates pressure on weaker institutions. Liquidity dries up not because of immediate risk, but because of perceived vulnerability. Federal Reserve policy plays a central role in the trajectory of small banks. If interest rates remain elevated, unrealized losses will persist and refinancing pressure will increase. If rates fall too quickly, inflation may rise again, reducing the value of bank assets and increasing funding costs. There is no easy path. Every policy direction carries risks that disproportionately affect small institutions. These banks are caught in a delicate balance between interest rate policy, regulatory oversight, and economic forces they cannot control. The most concerning aspect of the current environment is that the vulnerabilities are cumulative. Small banks are not threatened by one problem, but by a combination of many: deposit flight, shrinking margins, bond losses, commercial real estate exposure, technological disadvantages, regulatory pressure, and demographic decline. Each issue alone might be manageable. Together, they form a structural challenge that threatens the long-term viability of the community banking model. The system is not collapsing suddenly. It is weakening steadily, one financial quarter at a time, in a way that is difficult for the public to notice. The stability of the next few years depends heavily on whether economic conditions stabilize or deteriorate. If the economy slows, defaults will rise, deposits will decline further, and loan stress will intensify. If interest rates stay high, unrealized losses will persist, and financing conditions will tighten. If rates fall too quickly, inflation could reappear, further eroding purchasing power and pressuring savings. In every scenario, small banks face challenges that require resilience they may not possess. What makes this moment unique is that the traditional tools used to support small banks, emergency lending, temporary liquidity, and regulatory forbearance, can delay problems but cannot resolve the underlying issues. The banking landscape is evolving faster than community banks can adapt. Technology, demographics, interest rate cycles, and economic forces are converging to reshape how financial stability is maintained. Small banks are positioned on the front line of that transformation. The country may soon face a period where small bank failures increase gradually, not through a dramatic crisis, but through a prolonged wave of weekend closures and quiet consolidations. The FDIC may arrange more mergers. The public may barely notice each individual event, but the cumulative effect will be significant. Communities will lose local lenders. Businesses will lose funding options. The economy will lose resilience. And the financial system will become more concentrated in fewer, larger institutions. This hidden banking crisis is not defined by panic, but by erosion. It is not loud. It is not chaotic. It is steady, structural, and deeply consequential. The institutions closest to the edge are those least capable of defending themselves. And unless the underlying dynamics shift, the pressure on small banks will only grow. The most important question now is not whether small banks are vulnerable. That has already been proven by the data, the deposit flows, and the financial structure they operate within. The real question is how this vulnerability evolves into an event that affects the entire country. Banking crises do not begin with a dramatic explosion. They begin with subtle shifts in confidence, liquidity, and asset valuations. When conditions tighten, these small tremors spread outward from the weakest institutions. In a highly interconnected system, the failure of even one regional bank can push others into defensive behavior, which then restricts lending, reduces liquidity, and slows economic activity. The danger is not isolated failure. The danger is accumulation. And the United States is now entering a period where that accumulation is becoming statistically more likely. One of the clearest triggers for this pressure is the refinancing cycle for commercial real estate. Many of the loans made in the past decade, when interest rates were low and valuations were rising, are now coming due. Borrowers must refinance at higher rates, often with properties that are now worth significantly less. In many cases, the new financing terms do not work. Cash flows from the properties are insufficient to support the new payments. When refinancing fails, borrowers either default or attempt to restructure. These outcomes place direct pressure on the banks holding those loans. If the loans are downgraded, the bank must increase reserves, reducing its capital. If they default, the bank must absorb losses or take possession of properties already declining in value. This reflex was evident during the 2023 bank collapses, when institutions not directly affected by the crisis still saw billions leave their accounts in a matter of days. The pattern is predictable. Large banks benefit from fear because they are considered safer. Small banks suffer because they lack the same perception of stability. This psychological imbalance creates an uneven playing field where confidence, rather than fundamentals, drives behavior. In a system so dependent on trust, perception becomes reality. The long-term consequence of this shift is a slow consolidation of the banking sector. As small banks lose deposits, face loan stress, and experience regulatory pressure, many will seek mergers as a survival strategy. Others will attempt to restructure. Some will quietly fail over weekends, taken over by the FDIC and absorbed by more stable institutions. This does not resemble the dramatic collapses of the past. It resembles a controlled but persistent thinning of the financial landscape. The number of community banks has been declining for decades, but the pace of that decline is likely to accelerate as economic pressure intensifies. What makes this process more concerning is the role small banks play in the economy. They are not simply financial institutions. They are economic engines for millions of Americans. Small businesses rely on them for credit. Local industries depend on them for financing. First-time homebuyers often secure mortgages through them. Farmers, contractors, independent operators, medical offices, and regional employers all depend on small banks for lending that large institutions are often unwilling to provide. When these banks weaken, the effects do not remain within the financial sector. They spread into communities, slowing job creation, reducing investment, and weakening economic resilience. The hidden banking crisis is not just about institutions. It is about the economic infrastructure they support. Another factor shaping the future is the evolution of digital finance. The rise of mobile banking, real-time payments, online lending, and financial technology companies means that customers have more options than ever before. Fintech platforms offer high-yield savings, instant loans, automated investing, and seamless experiences. These platforms operate without branches, without heavy staff requirements, and without the legacy systems that burden traditional banks. For many customers, especially younger generations, the idea of banking locally does not hold the same value it once did. Convenience, speed, and returns matter more than location. This shift leaves small banks fighting a battle they were never built to win. They are competing in a digital market using analog tools. The Federal Reserve's role in this environment is controversial. High interest rates were necessary to fight inflation, but they created deep fractures in the banking system. Those fractures disproportionately impacted institutions with long-term bond holdings and slow-moving deposit bases. The Fed introduced backstop facilities to prevent panic, but these measures were temporary and cannot fix structural weaknesses. The reality is that the system was never designed to handle such rapid monetary tightening. Large banks adapted. Small banks absorbed the damage. And now the consequences are unfolding gradually, not through headlines, but through balance sheets across the country. The hidden banking crisis also reflects a deeper trend, the concentration of financial power. Over the past several decades, economic influence has been shifting toward the largest institutions. Big banks have more resources, more technology, more stability, and more political weight. Smaller banks have more vulnerability, more exposure, and fewer tools. Every financial shock accelerates this imbalance. The more concentrated the banking system becomes, the less resilient it is. Localized shocks hit harder. Economic downturns spread faster. Lending becomes more centralized, less tailored, and more sensitive to national rather than regional conditions. In an economy as diverse as the United States, this creates a mismatch between financial supply and real economic needs. The next stage of the crisis may not begin with bank failures, but with lending contraction. When banks feel uncertain about their balance sheets, they pull back. Loan approvals decline. Underwriting becomes stricter. Credit becomes more expensive or harder to obtain. Small businesses, which operate on tight margins and depend on steady access to financing, feel the impact first. This contraction is already visible in loan officer surveys and regional lending data. Even without failures, economic growth slows when credit tightens. The slowdown may feel subtle at first, but as small businesses delay expansion or reduce hiring, the effects accumulate. If the economy enters a recession, the stress on small banks will intensify sharply. Loan defaults rise during downturns. Commercial real estate weakness accelerates. Consumers fall behind on payments. Businesses delay repayments or restructure debt. Each of these pressures cuts directly into the revenue and capital positions of smaller institutions. Recession turns structural weaknesses into urgent threats, forcing regulators to respond quickly to preserve stability. While the Federal Reserve can provide liquidity, it cannot restore solvency. Solvency depends on asset quality, capital strength, and profitability, all areas where small banks are stretched thin. Another subtle but important factor is the erosion of the relationship-based model that once defined community banking. For decades, small banks thrived because they knew their customers personally. Decisions were based on local insight, not algorithms. But today, data-driven lending outperforms relationship lending in accuracy and speed. The value of personal familiarity has diminished. Small banks can no longer compete with the analytical precision of large institutions or fintech platforms. This shift undermines the foundation that once justified their existence. Without this advantage, Many small banks lack a reason for customers to choose them. Some analysts argue that the economy can adjust to a smaller banking sector and that the loss of community banks will not cause systemic damage. But history suggests otherwise. Decentralized lending systems are more resilient because they distribute risk across regions and institutions. Centralized systems create concentration risk. If one major institution faces pressure, the effect spreads quickly, affecting millions of customers simultaneously. The disappearance of small banks makes the financial system more fragile, not more stable. Local knowledge is lost. Regional economies become dependent on national institutions that may not prioritize their needs. This structural imbalance has long-term consequences for economic health and financial inclusion. In the coming years, the most likely outcome is a gradual transformation rather than a sudden collapse. Small banks will continue to operate, but many will shrink, merge, or quietly fail. Regulatory policy will evolve to manage consolidation, but consolidation itself cannot fix the root problems. Technology and scale will continue to drive financial power upward. Deposit flows will increasingly favor large institutions and high-yield alternatives. Commercial real estate stress will expose weaker balance sheets. Interest rate cycles will determine the pace, but not the direction of change. The system is moving toward a future where small banks play a diminished role. Yet the story is not purely deterministic. There are pathways to stabilization, but they require innovation, adaptation, and strategic reinvention. Some community banks will pivot toward digital tools that improve efficiency. Others will focus on specialized lending niches that remain profitable. Some will form alliances to share technology costs and regulatory burdens. A few may even emerge stronger by restructuring early and aggressively. But these success stories will be exceptions in a broader environment defined by pressure. The hidden banking crisis is unfolding in slow motion. It is not loud because slow crises rarely are. They build quietly, shaped by economics rather than emotion. But even quiet crises can reshape a country. The weakening of small banks affects businesses, households, jobs, investment, and community stability. It concentrates power in ways that change how credit flows through the economy. And it pushes the financial system toward a future where resilience depends on fewer, larger institutions. Whether the public recognizes it or not, the transformation of American banking is already underway. The vulnerabilities exposed in 2023 were not anomalies. They were warnings. And unless the system adapts, the future will be defined not by a single dramatic event, but by the cumulative weight of small failures that signal a much larger shift. The slow, steady fracture of the banking foundation that once supported the world's largest economy.